had to say about gold today, and it is a red flag for the economy. It's pretty loud out here, so let's run in really quick. Okay, so UBS came out with a piece and suggested that gold might indeed be a leading indicator, not just of those geopolitical tensions that we're seeing, but also of recessionary fears. And they gave prices for where gold can go in recessionary times. They used 3 examples: 1972, 1978, and 2008. In each of those instances, gold doubled or tripled in value. Now this makes sense. It corresponds with a recession. It also corresponds with real rates going negative, which also makes sense. Just so you know, that's a really fancy way of basically saying the Fed is cutting interest rates below the level of inflation. They do that because they want to stimulate the economy and minimize the fact that, oh no, we actually have a potential recession on our hands, and that'll lead to joblessness, and then the other side of the Fed's dual mandate becomes a lot more important, which is the labor side. At the same time, though, gold and gold-related stocks moved substantially. Again, you look them up yourself. One of the easiest ways to get exposure might be a gold-based ETF, which might be like an IAU. I don't have any exposure to IAU. Another one that a lot of folks are paying attention to, which I do have exposure to, is Barrick Gold. That's just a gold mining company. They've got somewhere around $700 to $800 million of free cash flow. They've got a substantial set of assets relative to the debts they have. They're about 50% debt relative to their actual plant, property, and equipment, which makes a lot of sense that you would finance some of your equipment or your land. And while there's still work to do in terms of a full fundamental analysis on that company, it is interesting as a potential macro hedge. And that's what a lot of folks are paying attention to. Is gold potentially a macro hedge for a recession? Now, here's the problem with pitching gold. And I don't want to come across as pitching gold, but this is UBS suggesting that if we go into a recession, gold could do really well, and guess what could do really poorly? Equities. Now that makes sense. It would make sense that equities wouldn't do that well in a recession and gold would do really well. And the question right now is, do we really see signs of a recession? And so on that front, no, we don't. Lagging indicators are doing very well, like jobs, but again, lagging indicators. One of the signs we got from the banks today was actually from a company like, you may have heard of them, JP Morgan and Chase. And what do they tell us? Loan growth is finally slowing. And so net interest margins or net interest income is starting to grow at a slower pace or decline. And a lot of folks thought that the growth that we were seeing at banks would not end. That's a little bit of a problem, because when you get markets that assume growth isn't going to stop, you get frothy valuations. This is potentially what you've seen in the AI trade as well. Speaking of trade, by the way, I had a bad day yesterday. Yesterday on a day trade, I was down at one point $35,000. We ended that day trade down net with the gains and losses down about 10,200. So that sucked. And I did a whole explanation video in the Course Member Live this morning in terms of what mistake I made and how I could prevent that in the future. The good news is I implemented part of the strategy, and today we were able to day trade call options on Tesla when it hit its floor twice and pulled out a 20K gain. And we also pulled some other trade this morning, which also worked out pretty well depending on the timing of how you played it. So, point of this is, if you want all those stocks and psychology of money trade alerts, make sure you're part of them. Not always a win, but even in the losses, there are big lessons and they help us set up for wins the next day. So check those out. You get all the trade alerts in the Stocks and Psychology of Money group, link down below. Now, as far as recession, am I all of a sudden a recession bear? No. I'm just reading to you what UBS is warning. UBS put out a big piece yesterday, and other companies like Macro Ear and other researchers are going, oh, whoa. They're paying attention to this. what's interesting is about a month ago, we did a piece on the channel where we talked about Goldman Sachs saying, hey, now might be a time to go long volatility as a hedge to your portfolio. So you buy call options on like the VIX, for example, or a derivative of the VIX. That ended up working out really well over the last week or so because, I mean, the VIX today was up like 25%. So sometimes what these researchers are saying in terms of, hey, like, you might want to pay attention to this, they're not without merit. Consider for a moment that, yes, with a time potentially to set up a hedge for a recession is when nobody's expecting a recession. We've gone from last year, everybody thinking there was a 50% chance of recession, to like now most people going, we're probably back to normal levels, like 20% chance of recession. The problem though is, the longer we keep rates higher for longer, the longer we basically start putting pressure against the recessionary wall, and then things start to break. Things start to break when we start seeing debt bubbles starting to explode. Not seeing that so much yet. You're seeing pain in the subprime autos. We saw that in the Fed minutes. We saw that in the JPM earnings call. And we're seeing a lot of commercial property distress, but not so much in multifamily. That's being considered relatively stable. We're seeing rents stabilize, but we are seeing people who have a lot of debt, buy now, pay later debt, consumer debt, variable interest rate loan debt. And so we're seeing foreclosures start to rise, certainly in the multifamily side, and also on FHA. So some of the early signs of cracking are starting to show up, and that might be why gold hit $2,400 an ounce today. Now, we did get rejected at $2,400 an ounce. We're back down to $2,350. But based on that UBS survey, a lot of folks think, or maybe not survey, their research, a lot of folks think, does it actually make sense to start exposing yourself to maybe 1 to 5% gold as a hedge? I don't know. It really requires a recession for that to play out. If you don't get a recession, you might be buying at levels where gold's already gone up a chunk. We're up somewhere around $300-400 just over the last few months on a per ounce basis of gold, which is somewhere around 15-20ish%. So it's possible that if we just keep getting great economic news, maybe that's a bad move. And I'm not advocating for anything one way or another, but what I am saying is UBS is under the impression there's a big opportunity there. And again, what they say is watch for real rates going negative because it pumps gold. Watch for recessions because it pumps gold in 72, 78, look at the charts, and 2008, 2 to 3x. I think it was 3x, 3x, and 2x, if I remember correctly. So again, not here to shill it. Got a tiny bit of exposure to Barrick Gold. It's super, super nominal. And I don't even know if that's the best play yet. So it's certainly not research here. This is not financial advice. It's not personal advice by any means. These are just opinions based on what I read from UBS. We read that in our course member live stream, and we talked about it in our public live a little bit this morning, and I wanted to go a little bit more into detail on it and how it's somewhat relating to what we're seeing with banks, concerns about debt, and as sort of a hedge tool, which we saw pitched with the VIX as well, and Goldman was right on that. So what I want to know now is, will UBS be right as well? Let me know in the comments down below. And check out the Stocks and Psychology of Money trade alerts. Again, we're up 20K today, and that is financing my trip today because we're looking at real estate out here, and I pay for the flights, and I think I just paid for a lot of fuel. Let's go.